Welcome back to our channel, Day to Day News. Today, we are diving into important changes in the US financial market. Starting today, US trading moves to a shorter settlement period. This change aims to reduce risk and improve efficiency, but may initially lead to an increase in transaction failure for investors. U.S. Securities and Exchange Commission (SEC) has implemented a rule requiring transactions in U.S. equities, corporate and municipal bonds, and other securities to be settled one business day after the trade instead of two. This transition to T+1 settlement follows Canada, Mexico, and Argentina, which made the switch yesterday. UK is expected to follow in 2027, and Europe is also considering the change. This move was driven by 2021 trading frenzy around GameStop, highlighting the need to reduce counterparty risk and improve capital efficiency. Shortening the settlement cycle reduces the time and risk involved in trades, making market infrastructure more resilient. However, there are risks. Firms now have less time to gather funds, recall shares on loan, or correct transaction errors, potentially increasing settlement failures and transaction costs. Settlement failures occur when buyers or sellers don't meet their obligation by the settlement date, leading to losses, penalty fees, and damage to reputation. Process of settlement involves transferring securities or funds between parties after a trade, managed by Depository Trust Company (DTC). The US is following lead of India and China, where fastest settlement is already in place. Over the weekend, market participants, including banks and regulators, worked to ensure smooth transition. A virtual command center was set up with over 1,000 participants ready to discuss the switch. Significant tests will occur on Wednesday when trades from both the old T+2 and new T+1 system are settled, likely increasing trade volume and failures initially. Despite extensive testing since August 2023, a temporary rise in settlement failure is expected, similar to 2017 shift to T+2. Failures could lead to substantial penalty fees, with the fail rate predicted to increase from 2.9% to 4.1%. The shift to T+1 is expected to reduce systematic risk by lowering counterparty exposure, improving liquidity, and decreasing margin and collateral requirements. However, it may transfer some risk to other areas such as foreign exchange for funding transactions and securities lending. Foreign investors holding nearly $27 trillion in US stock and bonds now have less time to source US dollars for trades. This change might require reliance on overnight funding markets, which can be costly due to high short-term financing rate. Exchange-traded funds (ETF) must also navigate multiple jurisdictional requirements and capital needs. It's anticipated that the full impact of this change will unfold gradually, not just in the first week. That's all for today's update on the US market shift to a shorter settlement period. Stay tuned for more insight and updates on our channel. Please like, share, subscribe Day to Day News channel. Thank you.